After studying this module, we shall be able to understand the concept of NPV and IRR, point out the similarities and differences between the two methods, identify the cases where the two methods bring out identical and different results, evaluate the proposals in case of conflict in ranking between the two methods.
A corporate financial decision maker has to make the multiple investment decisions not only for the smooth functioning of the firm but also for meeting the expectation of the shareholders at large. Quite often, when the funds available are limited or when the projects under consideration are mutually exclusive, the financial decision maker task becomes all the way more difficult and important. Since these investment proposals have a long-term horizon and are irreversible in nature, most of the decision makers consider two widely used methods of discounting the cash flow techniques. They are net present value and internal rate of return. Net present value is the difference between the present value of the cash flows and the present values of cash outflows. The net present value compares the value of a dollar today to the value of the same dollar in the future, taking inflation and returns into account. NPV analysis is sensitive to the reliability of the future cash inflows that our investment or project will yield and is used in capital budgeting to assess the profitability of an investment or a project. Internal rate of return is the discount rate often used in capital budgeting that makes the net present value of all the cash flows from a particular project equal to zero. Generally speaking, a higher the project's internal rate of return, the more desirable is to undertake that project. As such, IRR can be used to rank several prospective projects of the firm in considering. Assuming all other factors are equal among the various projects, the project with the highest IRR would probably be considered the best and undertaken first. We can think of IRR as the rate of growth a project is expected to generate, while the actual rate of return that the given project ends up generating will often differ from its estimated IRR rate. A project with a sustainable higher IRR value than other available options would still provide a better chance of a strong growth. Internal rate of return can also be compared against the prevailing rate of returns in the security markets. If a firm cannot find any project with the internal rate of return greater than the returns that are generated in the financial markets, it can simply choose to invest its retained earnings into the market.
Let us understand the concept of NPV first. NPV stands for net present value. It is a discounting technique where the underlying discount rate is assumed to be the cost of capital of the firm. NPV is the difference between present value of cash inflows and present value of cash outflows. Since the cash outflows and inflows arise at the different points of time and cannot be compared, both are reduced to their present values at the rate of return acceptable to the firm. The rate of return is overall cost of capital, which takes into the account the shareholders' expectation, business risk, and leverage. It is assumed that the cash inflows are reinvested at the same discount rate. The formula for calculating NPV is where NPV is equal to net present value, CT is equal to cash flows occurring in different time periods, C0 is equal to initial cash outflow, K is equal to discount rate or cost of capital, N is equal to life of project in years. Let us now see what are the decision criteria for the acceptance or rejection of the proposal using NPV. If NPV is greater than 0, the investor will accept the proposal. If NPV is equal to 0, then the investor will be indifferent towards the acceptance or rejection of the proposal. And lastly, if NPV is less than 0, then the investor will reject the proposal.
The advantages of using net present value method are: net present value gives importance to the time value of money. In calculation of the net present value, both after cash flow and before cash flow over the lifespan of the project are considered. Profitability and the risk of the projects are given high priority. Net present value helps in maximizing the firm's value. However, net present value has certain limitations too. These are: the net present value is difficult to use. The net present value cannot give accurate decisions. If the amount of investment of mutually exclusive projects is not equal, it is difficult to calculate the appropriate discount rate, and the net present value may not give correct decisions when the projects are of unequal life.
Now, let us discuss about the second prominent discounting technique, which is IRR. It stands for internal rate of return, that is, a rate at which the present value of cash outflows is equal to present value of cash inflows. In other words, IRR is the rate at which NPV is equal to 0. This rate is unknown and it is generated by trial and error method. Unlike NPV, here the discount rate is unknown. Rather, the rate is ascertained by trial and error procedure. This rate is then compared with the cut-off rate, generally taken to be the cost of capital, to arrive at a decision.
The internal rate of return on an investment or a project is the annualized effective compounded return rate, or the rate of return that makes the net present value of all cash flows, both positive and negative, from the particular investment equal to 0. It can also be defined as the discount rate at which the present value of all future cash flow is equal to the initial investment, or in other words, the rate at which an investment breaks even. In more specific terms, the internal rate of return of an investment is the discount rate at which the net present value of the cost, negative cash flows of the investment equals the net present value of the benefits, that is the positive cash flows of the investment. IRR calculations are commonly used to evaluate the desirability of investment or the projects. Higher a project internal rate of return, the more desirable it is to undertake the project. Assuming all projects require the same amount of upfront investments, the project with the highest internal rate of return would be considered the best and undertaken first. A firm or an individual should, in theory, undertake all the projects or investments available with internal rate of returns that exceed the cost of capital. Investment may be limited by availability of the funds to the firm or the firm's capacity or ability to manage the numerous projects.
The formula for calculation of IRR is where RL is equal to rate of return at lower rate, RH is equal to rate of return at higher rate, NPVL is equal to net present value at lower rate, NPVH is equal to net present value at higher rate. Let us now see what are the decision criteria for the acceptance or rejection of the proposal using IRR. If R is greater than K, the investor will accept the proposal. If R is equal to K, then the investor will be indifferent towards the acceptance or rejection of the proposal. And lastly, if R is less than the K, the investor will reject the proposal.
Because of the internal rate of return is a rate quantity, it is the indicator of the efficiency, quality, or yield of an investment. This is in contrast with the net present value, which is an indicator of the value or magnitude of an investment. An investment is considered acceptable if its internal rate of return is greater than the established minimum acceptable rate of return or the cost of capital. In a scenario where an investment is considered by a firm that has the shareholders, this minimum rate is the cost of capital of the investment, which may be determined by the risk adjusted cost of capital of alternative investments. This ensures that investment is supported by equity shareholders, since in general an investment whose IRR exceeds its cost of capital adds the value to the company, that is, it is economically profitable. On the other hand, the use of internal rate of return is by the corporations that wish to compare the capital projects. For example, a corporation will evaluate an investment in a new plant versus an extension of an existing plant based on internal rate of return of each project. In such a case, each new capital project must produce an internal rate of return that is higher than the company's cost of capital. Once this hurdle is surpassed, the project with the highest internal rate of return would be wiser investment, all other things being equal, including the risk. Internal rate of return is also useful for the corporations in evaluating the stock buyback programs. Clearly, if a company allocates a substantial amount to a stock buyback, the analysis must show that the company's own stock is a better investment than any other use of the funds for other capital projects, or that any acquisition candidate at the current market prices.
The points of similarities between the two methods are time value of money. Both methods recognize the time value of money, that is, a rupee earned today is always preferred over the rupee earned tomorrow. Consider total cash flows. Both methods take into the account all the cash flows over the entire proposal life to give results and thus give a true measure of profitability. Consistent with the objective of wealth maximization. The objective of financial management is to maximize the economic well being of the owners, that is, shareholders' wealth maximization. Both NPV and IRR result in maximization of the shareholders' wealth. There are also points of differences between the two techniques. These are discount rate. Under NPV method, the underlying discount rate is also known and is equal to the opportunity cost of capital, as it represents the minimum rate of return required to accept a project. However, under IRR method, the discount rate is unknown and it is generated by the trial and error procedure. The IRR equates the present value of outflows with the present value of cash inflows. Reinvestment assumption. Though both the methods assume the intermediate cash inflows are reinvested at the discount rates, NPV methods assume that these cash inflows are reinvested at the cost of capital, while IRR method assumes the reinvestment at IRR. The assumption of NPV is more realistic as it indicates that all proposals earn at least the cost of capital. Multiple rates. Due to the mathematics inherently involved in IRR, sometimes it may result in negative or multiple internal rates. It mainly happens in non-conventional investment. However, this limitation is not suffered by NPV method. Value additivity principle. NPV of two different proposals can be added. However, IRR of two proposals cannot be added. This is due to the fact that NPV is an absolute measure while IRR is a relative measure.
In capital budgeting, there are a number of different approaches that can be used to evaluate any given project. And each approach has its own distinct advantages and disadvantages. All other things being equal, using the internal rate of return and the net present value measures to evaluate the projects often results in the same findings. However, there are a number of projects for which using the internal rate of return is not as effective as using the net present value to discount the cash flows. Internal rate of return major limitations is also its great strength. It uses one single discount rate to evaluate each investment. Although using one discount rate simplifies the matter, there are a number of situations that cause the problems for internal rate of return. If an analysis is evaluating the two projects, both of which share a common discount rate, predictable cash flows, equal risk and a shorter time horizons, the internal rate of return will probably work. The catch is that the discount rate usually change the sustainability over time. For example, think about using the rate of return on the T-bill in the last 20 years as a discount rate. One T-bill returned between 1% and 12% in the last 20 years. So clearly the discount rate is changing. Without modification, internal rate of return does not account for changing discounting rates. So it's just not adequate for the long-term projects with a discount rate that are expected to vary. Another type of project for which a basic internal rate of return calculation is ineffective is a project with a mixture of multiple positive and the negative cash flows. Thus, there are at least two situations and solutions for internal rate of return that make the equal equation to zero. So, there are multiple rate of returns for the project that produce the multiple internal rate of returns. The advantage of using the net present value here is that the net present value can handle multiple discount rates without any problem. Each cash flow can be discounted separately from the other. Another situation that causes the problem for using of internal rate of return method is that when the discount rate of a project is not known. In order for the internal rate of return to be considered a valid way of evaluating a project, it must be compared to a discount rate. If the internal rate of return is above the discount rate, the project is feasible. If it is below, the project is considered infeasible. If a discount rate is not known or cannot be applied to a specific project for whatever reasons, the internal rate of return is the limited value. In certain cases, net present value method is superior. If a project net present value is above zero, then it is considered to be financially worthwhile. So why the internal rate of return method still commonly used in the capital budgeting? Its popularity is probably a direct result of its reporting simplicity. The net present value method is inherently a complex and requires the assumptions at each stage: discount rate, likelihood of receiving the cash payments, etc. The internal rate of return method simplifies the project to a single number that management can use to determine whether or not a project is economically viable. The result is simple, but for any project that is long term, that has multiple cash flows at the different discount rates, or that uncertain cash flows in fact for almost any projects at all, simple internal rate of return isn't good for such more than presentation value.
The diagram depicts the nature of the results under both the methods. Despite the fact that the differences exist between the two methods, IRR will give same results as NPV in the following circumstances. First, conventional cash flows. It is a situation where an initial cash flow is followed by a series of cash inflows. Second, independent investment proposal. Proposals where the acceptance of one proposal does not result in non-acceptance of the other. Here, all the proposals above the cut-off rate can be accepted. Under NPV method, we accept a proposal when we get positive NPV, that is, NPV is greater than 0. And under IRR method, we accept a proposal when internal rate of return is greater than the firm's cost of capital. Whenever R is greater than K, NPV shall be positive. The two methods give contradictory results in the case of mutually exclusive proposals. These are the proposals where the acceptance of one proposal leads to non-acceptance of the other. There are two types of mutually exclusive proposals. These are technical exclusiveness. It refers to the selection of the most profitable proposal out of the proposals under consideration. Financial exclusiveness. It is the exclusiveness which is imposed due to the financial constraints, that is, where firms' funds are limited. In case of mutually exclusive proposals, NPV and IRR methods will give conflicting ranking due to the following reasons. First, size disparity problem. Second, time disparity problem. Third, life disparity problem. Let us understand the size disparity problem. It arises due to the difference in investment size. NPV and IRR shall give conflicting ranking due to the fact that NPV deals with the absolute net benefits and is therefore affected by the size of investment. Higher the investment, higher the expected returns in absolute terms, and hence it would give higher ranking. On the other hand, IRR deals with the relative returns and is not affected by the size. Even if all the cash flows are doubled, IRR shall remain unchanged. While facing life disparity problem, if the firm has huge fund for investment, it should go for decision according to NPV method. However, if the firm is suffering from liquidity crunch, it should decide according to the profitability index method.
Let us now consider an example to understand the concept of size disparity. We are considering two mutually exclusive projects A and B with the details as shown in the table. The cash flows of project A and project B is 10,000 and rupees 40,000 respectively. The cash flow into project A for 3 years is rupees 5,000, 6,000, 4,000 respectively, and for the project B, the cash inflows are 18,000, 20,000, 15,000 respectively. The cost of capital is 10%. Now substituting this value in the formula of NPV, NPV is equal to summation of T goes to 1 to N Ct upon brackets open 1 plus K to the power T minus CO. NPV comes out of to be 2,509.39 for project A, 4,162.28 for project B. Similarly, by using the formula of internal rate of return, which is equal to RL plus brackets open NPV upon L divided by NPVL minus NPVH bracket closed into RH minus RL, we can compute the internal rate of return. The internal rate of return for project A comes out to be 24% and 16% for the project B. Thus, we can see the results using the two techniques are entirely different. Both the methods are giving conflicting rankings. Project B should be selected according to NPV method, while project A should be selected according to IRR method. NPV deals with the absolute net profits and the benefits, and is therefore affected by the size of investment. Higher the investment, higher the expected returns in the absolute terms and hence higher rankings. In the above example, project B, investment is 4 times to that of project A. Therefore, net present value gives higher ranking to this project. On the other hand, internal rate of return deals with the relative returns and is not affected by the size. Even if all the cash flows are doubled, internal rate of return shall remain unchanged. Thus, considering the relative returns in the project A shall be selected. It is given higher returns, that is 24%. When the firm has huge funds for investments, it should go for a decision according to the net present value method. However, when the firm is suffering from liquidity crunch, it should decide according to the profitability index method.
Moreover, we can also face time disparity problem when the timings of the cash inflows differ. The conflict in ranking arises due to the reinvestment rate assumption, which has already been discussed. Since the inherent assumption of reinvestment at generated IRR is absurd and unrealistic, one should use NPV as a decision criteria under time disparity.
Time disparity problem occurs to difference in timings of the cash flows of different proposals. This situation arises when the relative larger cash flows of a proposal occur in earlier periods of its expected life, whereas relatively large cash flows of another proposal occur in the later periods. Let us understand the problem with the help of an example. As we can see in the table, the net present value for the project A is 1321.97 and 2932.18 for project B. The internal rate of return for project A is 14%, while that for the project B is only 13%. The conflict in ranking arises due to reinvestment rate assumption. According to net present value method, the cash flows are getting reinvested at a 10%, while internal rate of return assumes the reinvestment is made at 14% and 13% for project A and project B respectively. Since the inherent assumption of reinvestment at generated internal rate of return is absurd and unrealistic, one should use the net present value as a decision criteria under the time disparity.
Lastly, NPV and IRR can also give conflicting ranking due to life disparity problem. It arises due to the difference in the expected lives of the projects. Whenever a firm faces life disparity problem, it is advisable to use EANPV, that is equivalent annual net present value method, to arrive at the concrete decision. The EANPV method makes projects with unequal lives comparable and thus a better approach over NPV in the life disparity problems.
The difference in ranking can also occur due to difference in the expected lives of the concerned projects. Let us say we are considering two projects, project A with expected life of 1 year and project B with expected life of 4 years. The other details of the projects are as shown in the table. As it can be seen from the calculations in the table, even though the initial outlay in both the projects is the same, still both methods are giving contradicting rankings. It is due to the difference in the expected life of the projects. While according to internal rate of return method, the project A should be chosen since its internal rate of return is double than that of the project of B. The net present value method is giving a different signal. In the absolute terms, project B should be chosen over project A as it is resulting in higher net present value despite the longer economic life. Whenever a project faces the life disparity problem, it is advisable to use the ENPV, that is equivalent annual net present value method, to arrive at a concrete decision. The equivalent annual net present value method makes the project's unequal lives comparable and thus a better approach over net present value in life disparity problems.
Let us now summarize what we have learned in this module. In this module, we have learned about the concepts of NPV and IRR and their points of similarities and difference. Moreover, we also understood the situations where two methods result in the same and contradictory results. We also discussed the three problems where two methods give conflicting ranking to mutually exclusive projects.
Let us recapitulate what we have learned in this module. The net present value and internal rate of return are two critical capital budgeting evaluating methods. The net present value is difference between the present value of the inflows and the present value of the outflows. The internal rate of return is the rate at which the net present value is equal to 0. The net present value and internal rate of return are similar as both the methods recognize the time value of money. Consider the total cash flows and are consistent with the objective of shareholder wealth maximization. Both methods can be distinguished on ground of discount rate. They consider their reinvestment assumptions, multiplicity of rates and the value additive property. The net present value and internal rate of return give consistent results in case of independent and conventional investment proposals and contrasting results when the proposals are mutually exclusive. Points of conflict in ranking of the two methods arise due to problem of disparity in terms of size, time and life.